Good afternoon and happy Friday to our valued shareholders, clients, and stakeholders. We thank you very much for joining us today for the Barita Beat, where we'll be providing you with an in-depth review of our third quarter financial performance. I'm Kerry Bayliss, Vice President for Strategic Business Development and Investor Relations here at Barita, and our moderator for today's earnings call. I'm joined by members of our executive management team who will be leading the discussions today. So please allow me to introduce Ramon Small-Ferguson, Chief Executive Officer of Barita Investments Limited and Managing Director of Barita Unit Trust Management Company Limited. Also with us today is Dane Broadbow, our CEO Designate for the Financial Holding Company and Acting CEO for the Cornerstone Trust and Merchant Bank, as well as Stephen Philibert, our Chief Financial Officer. The format for today will see us starting with a presentation on Barita's Q3 financial results ending June 30th, 2024, which will give a detailed outline of our financials and the factors that contributed to another quarter of positive earnings, followed by a business review that will touch on our operations, market conditions, and key strategic initiatives. Now, we always appreciate the opportunity to interact with you, our valued stakeholders, and to be able to answer any of your queries. So as we go along, please do feel free to enter your questions into the Q&A section on the screen. And once the presentations have concluded, we'll seek to answer them as best as we can. So without further ado, I'll hand over to our CFO, Stephen, so we can begin.
Thank you, Kerry. Good afternoon, ladies and gentlemen. It's my pleasure to take you through our financial highlights for the third quarter of 2024. So we start on the operating income slide. Net operating income has decreased marginally, about 5% to 7 billion from just under 7.4 billion in the prior year. And we'll look at the lines that make that up. Net interest income, we're now seeing small improvements in net interest income year over year to 479 million from 423. So what this is reflecting is, as there has been a pause now in the increases in interest rates that we had previously seen from the central bank, our stock of interest-bearing assets is now catching up, as it were, to the impact on our interest expense. And so we're starting to see that improvement even before there is an actual decline in rates, which we continue to hope will be in the offing before too long. Fees and commissions income up to 2.9 billion, just under, relative to 2.7 in the prior year. It's up 6% increase and is primarily driven by a better outturn in our investment banking line. And we're particularly pleased about that. It's one of the revenue lines that we have placed a great deal of focus on since Cornerstone has had stewardship of Barita. And finally, gain on investments, we're at 3.2 billion relative to 3.7 billion in the prior year. Now, the prior year had been impacted by a very significant gain on our real estate investments. And while we do have gains as well in the current year, they were not at the same magnitude. So that decline was partially offset by a better outturn in gain on sale of investments. But it leaves that decline of approximately 13%. Turning to operating expenses, we're seeing those decline from 3.3 billion last year to just under 3.2 billion this year. And in that breakdown, we start with the staff costs, where you're seeing now year over year, we have a 2% decline from 1.3 billion flat to 1.27. So just under. This is as a result of the restructuring exercise that we've communicated with you about before. We know that in the first quarter of the financial year, we actually saw an increase in staff costs because of the one-off expenses associated with that restructuring. And in quarters 2 and 3, we've seen the benefit of that restructuring with a slower run rate of staff costs. And now it has accumulated that benefit to the point where it outweighs the one-off costs. And so we're now seeing that decline. In administration expenses, we're seeing 2.06 billion relative to 2.14 in the prior year. This decline is driven by two things. One is general expense management, which we are diligent about. And the second is a reclass of certain expenses that have to do with our technology implementation. The nature of that implementation has changed. And with that change, it leads to a different accounting treatment for certain of the expenditures that have taken place in that project. And finally, we have the impairment slash ECL charges, which are reflecting write-backs as they did in the prior year of roughly the same quantum. Overall expense ratio, 45% as it was in the prior year. Okay, so we look here at, I'll start at the bottom of the slide on profitability and per share data. So having looked at the revenue side and the expense side, the net outturn, net profit after tax is just under 2.9 billion relative to just under 3.1 in the prior year, a 6% decline. And on the EPS side, it's $2.41 relative to 2.58 in the prior year, which is roughly about the same percentage. It's rounding that appears to create that difference. On the balance sheet, total assets continue to grow. We're at 135 billion relative to 128 as at the audited results last September, up 5% growth. And the largest line items are our investment portfolio, which is comprised of the pledged assets and marketable securities lines combined. So those combined to roughly flat year on year, just above 105 billion relative to a little below it in 2023. The other large line that we highlight here is loans, and we've seen growth of about 8% in that line to 11.8 billion from 10.9. On the funding side, we see a 6% growth in total liabilities to just under 99 billion from just under 93 in the prior year. And that is driven predominantly by the change you're seeing on screen in repurchase agreements, up about $10 billion or 13% to 85 billion. We've seen a decline in secured investment notes, which is at about $1.5 billion now. So it's become a fairly minor component of overall funding at just about 1.5% as it stands currently. And finally, we have other debt facilities, which is at about 6.8 billion rounded relative to 8.3 in the prior year. Shareholders' equity continues to be very strong. It's up marginally 2% to 36.2 relative to 35.4 in the prior year. And that capital leads to an adequacy ratio of 26.7 for Barita relative to the industry average of 21.2. And of course, the FSC's minimum requirement here is 10. So we're significantly north of that, strategically so, to position ourselves to take advantage of opportunities as they arise and to better manage risks as well. Okay, and just to recap the financial highlights, we have the main elements there: net operating revenue of 7 billion, net profits of 2.9 billion, and the rest of what you're seeing on screen. So with that, I'll close out this section and hand over to Ramon to take us through the rest of the management presentation.
Thank you very much, Stephen. Good afternoon, everyone. It's a pleasure to be with you again for another quarter to discuss the results of our business as shareholders. Stephen has gone through the financial highlights, and I'm tasked with giving some context to those highlights. Right? So the first point of discussion, as usual, is the global and local macroeconomic environment. On the local front, economic growth remains strong and positive, albeit we have experienced a declining trend in the extent of growth over the last few quarters. Right? Near-term growth expectations, however, are not so positive. Right? On the back of, or rather in the face of the headwinds presented by Hurricane Beryl, which struck our island in early July. It's anticipated that these effects, lagged as they are, may result in a decline in our economic stock. In other words, growth will become negative during the next quarter. We do, however, believe that this will be transitory. We think the anchors that will drive longer term growth are well sustained. And we believe that, the picture beyond the next quarter is actually positive. One of the major tailwinds of this expectation of a resumption of positive growth is the state of our public debt, which is an underlying factor to macroeconomic stability. The rapid decline in public debt and the entrenched macroeconomic stability is well supported by, or continues to be well supported by, our policy frameworks. And that has become pivotal in the thinking around Jamaica's macroeconomic situation and the confidence that can be placed in what is expected from a fiscal perspective in future quarters. Right? The global environment has to be considered, obviously. And, Jamaica being a small, open economy, that is evidenced when we have these exogenous shocks, such as the hurricane, right? But what is important is for us to have buffers in place. And over the course of the last several years, we have sought to build up fiscal buffers, as evidenced by the continuous state of the fiscal balance, as evidenced by how net international reserves, for example, have grown. Inflation. The inflation rate decreased to 5.1% in July of 2024, down from a peak of 11.8% in April of 2022, right? And we have actually had now 5 consecutive months of the inflation rate being within the BOJ's target range. We are anticipating, however, like growth, that inflation will be adversely impacted by the effects of Beryl. And by adversely impacted, unlike growth, we are anticipating that we will see an uptick in inflation in the near term, reflecting the effects of increased food prices, as well as potential increases in fuel prices. Like the impact on growth, we are anticipating that this will be transitory and that the other factors that have anchored inflation at this lower level do remain in place, right? So we're expecting to see a reversal. Finally, on the monetary policy front, as has been very much discussed in this meeting and other forums, we have actually seen now further monetary policy action from the BOJ, right? Having signaled in June their intention to have a more decidedly easy monetary policy, with the first port of call being improving market liquidity conditions. What has happened now in the latest decision is that the BOJ has actually reduced their benchmark policy rate by 25 basis points from 7% to 6.75%, albeit while closely monitoring the state of inflation. Right? On the global front, the IMF projects global growth at 3.2% for 2024. And this is driven by expected convergence, positive convergence in advanced economies. Right? The US economy, there has been some moderation in the growth outlook there as the labor market has cooled, but this is expected to be partially offset by a pickup in the euro area. Right? So again, advanced economies fueling the overall global growth picture. Inflation. There is no momentum in the decline in global inflation, but that momentum is actually slowing, mainly due to elevated levels on the service front, right? And stronger disinflation in goods prices. Right? If you recall, global inflation would have seen an uptick on the back of supply chain issues that persisted post the more serious effects of the COVID-19 pandemic. And with that in the rearview mirror, the factors I mentioned are more prominently in focus. The monetary policy trend globally. So there is an index referred to as the Council on Foreign Relations Monetary Tracker, which essentially seeks to aggregate and give some directional view on monetary policy across the globe. And that index is actually showing a significant decrease to 2.46 in August 2024 from 8.16 in September 2023, effectively reflecting easier monetary policy in aggregate across the globe, right? Which is indicating that essentially central banks around the world seem to be moving towards an easier direction in aggregate, right? Now, how does this impact our business, right? We have consistently spoken about what we describe as the vectors of our performance, right? One vector is the tailwind of the evolving monetary policy environment, which is expected to enable further revenue diversification for Barita, right? And we have in turn been implementing initiatives in anticipation of this evolution to reduce singular reliance on any revenue line, right? Now, what are those initiatives? We've been optimizing the balance sheet of the business to align with this evolving monetary policy environment. We have been driving origination in certain key business lines. Stephen mentioned investment banking before, our asset management business as well, so that as conditions ease and improve, we will be well poised to benefit from an upsurge in business in those areas, right? Prudent capital management is another vector of our performance, right? And we have been speaking about our focus on ensuring that the business is very capable to take advantage of opportunities should they arise, right? So how have we been doing that? We've been positioning the business to be able to execute on market neutral investment strategies, right? So in other words, if the market were to go left, right, or up or down, we want to have a business that is well endowed to step in and take advantage of any opportunities that may present themselves. The key tenets to that strategy are our lower than average leverage and our liquidity and capital adequacy, which is we're well endowed in those two areas. The final point is optimizing our operational efficiency, right? And again, the primary area where we're focused on gaining these operational efficiencies is through an ultimate integration of our group through the one group structure, as we have called it, complemented by gains that we anticipate to get from technology, which will help us to drive productivity. So in other words, we are anticipating an ability to generate more revenues per unit of cost on balance. Right? Now, let me speak about this against the backdrop of our performance, right? As Stephen mentioned, we would have seen a moderation in investment gains relative to last year from, in particular, our real estate portfolio, right? And we would have spoken about this a lot, but these things you can't speak about too much, right? And, what is happening, as has been said before, but I'll reiterate again, is that we have now moved our real estate strategy squarely away from the acquisition phase, where the vast majority of returns would be garnered from any revaluation gains associated with the properties acquired, into the development phase of the life cycle. The development phase is characterized by putting together necessary partnerships and so on to drive the actual development of these properties. And we're happy to say that that phase is progressing well. and will culminate ultimately in our first development. So more to come shortly in relation to that. All right. With respect to operational efficiency, I mentioned the anticipated sources of operational efficiency being greater productivity. And productivity is not only driven by the middle line, right, which is cost, but it's also driven by us being able to generate revenues more efficiently. And with market conditions now aligning well with how we have positioned the business, we're expecting to see more opportunities for revenue generation from the investment banking sides of our business, our asset management business, which we believe can scale substantially while maintaining its existing cost base, right? And we're also seeing opportunities as well with respect to the positioning of our balance sheet in the face of declining interest rates, right? So, what's the tactical approach? What are we looking at over the next quarter or two? Right? The first is that continued revenue diversification. Right? We're very much focused on creating value through diversification. The second is maintaining our ability to execute on market neutral investment strategies. We think that, generally speaking, risk assets are better positioned now in the face of monetary policy easing seemingly permeating throughout the global environment. And finally, that operational efficiency lane is of great importance to us, both in the short and long term. All right. Let me close out by speaking a little bit about our business lines as usual, right? And for this quarter, we have recomposed the business line discussion a bit to be a bit more targeted and focused, where we've aggregated elements of the business under 4 umbrellas, right? The first is the investment banking business line, right? And this business line focuses on raising capital, providing financial advice, structuring transactions for clients, both locally and in the region in particular, right? And this business line is led by our SVP investment banking, Therese Kettle. Now, following a challenging year in 2023, where you can appreciate that capital markets were facing the headwinds associated with high interest rates, tighter monetary policy, lower liquidity, we have actually seen an uplift in activity on the capital market front, which has been a tailwind for this business line. And we are expecting this to hold, right? And based on what we're seeing, we see opportunities down the pipe for our investment banking business in both the areas of fundraising and financial advisory. On the alternative investment front, which is a business line which covers our exposures to real estate, private credit, and private equity, and soon we will see exposures associated with infrastructure in this business line. We spoke about the transition that is taking place with respect to the real estate strategy, but we believe in the face of improved liquidity conditions, lower rates, there will be an uplift in the pipeline of opportunities for private credit, private equity, and infrastructure type opportunities over the course of the next several quarters. So that area of our alternative investment exposures is expected to grow. On the asset management front, in the face of lower fixed rates, we are seeing opportunities for our unitized products becoming more attractive to investors who may be willing to take a bit more risk, given that the risk or the return rather per unit of risk in shorter term products will be reduced over the course of the next few quarters. And finally, on the treasury trading and brokerage front, which covers our on-balance sheet exposures, being our investment portfolios, our net interest income type business, in the face of lower rates, where our liabilities, which are shorter term in nature, will be repricing more frequently, and where our assets, some of which would have been on our books for several years, investments that we may have made in a low interest rate environment, as those mature, we're expecting that the combination of those two factors, coupled with a third factor being the growth of our balance sheet, we expect that to, generally speaking, influence up the returns that the business gets from the net interest income side of things. There may be more trading opportunities that present as interest rates are now stable to declining on the fixed income front. This could, of course, influence market conditions with respect to equities and other risk assets, which could be positive for on-balance sheet earnings. And year to date, we have actually seen an uplift in this area, generally speaking. So our outlook here is positive. That, I think, concludes my contribution today. And I'll hand over to Dane Bradborough to take us through the rest of the presentation. Here you go, Dane.
All right, thanks, Ramon. So I'm going to talk a bit about, Barita's risk posture and really some of the strategic considerations for the group. So, as mentioned in successive prior meetings, our capital strength served as a source of resilience as market conditions got difficult with rising interest rates, and also served as a stable base for our alternative investment strategy. Now, importantly, going forward, it's going to serve as a strong base for our growth, including, some of the dynamic investment posture that Ramon would have spoken of. And again, given the consistency of strength of capital across the group, going to augur well for the opportunities for growth within our group and in ways that are synergistic to our overall financial group. Now, the revenue diversification that Ramon would have spoken of is another key element of our resilience. It would have shown up in prior quarters when earnings from alternative investments would have supplemented the challenging environment for our traditional sources of revenue. And, even as that environment evolves, we continue to build our resilience through institutional support for our investment banking business, expansion of our fund management business, and the execution of our real estate strategy. Now, our financial resilience continues to be supplemented by the operational resilience through the maintenance of our focus on risk, governance, and controls. And again, this will continue to be an area of focus for us even as we look towards the growth opportunities. And in particular, focusing on risk at the first lines of defense and really permeating that risk culture to the various risk owners across the organization. We continue within Barita and as a group to invest in technology. We've spoken about the upgrade of our core system. That process continues and is making steady progress. And we spoke about ensuring that technology elsewhere throughout the group will have seamless utility to Barita and its customers as we look to permeate that digital-first posture throughout the group. Now, again, the tech implementation and the tech investments will go at different speeds throughout the group, but are intended to converge towards the same ideal, which is having Barita lead the market as a digital-first group. Now, as mentioned previously, we look to position ourselves internally for the organization as we look to optimize the structure of our group. And again, we speak about the primary ideals surrounding that, which are customer centricity and efficiency. Customer centricity as we structure ourselves around our customer and have customer centricity as a core element of our culture throughout the organization, as we look to ensure that our clients have full access to the relevant capabilities of the group and curate specific customer experience models and standards for our various segments. From an efficiency standpoint, we look to unify best practices and standards across the group and streamline processes such that we're able to deliver those services as efficiently and as effectively as possible. So, when we think about what the core of our group's competence, will look like going forward, it's really, primarily along these lanes: innovation, risk management and risk capacity, and customer centricity. So innovation in terms of organizing ourselves structurally to deliver on continuous improvement and proactively meet the needs of our clients while optimizing efficiency. And of course, we'll tend to utilize cutting edge technology to advance in that respect. But not just necessarily in terms of technology. There are everyday gains that we get from the consistent review of our processes and really institutionalization of that consistent improvement. From a risk management perspective, we want to ensure that we maintain our financial resilience. We'll continue to hold above average levels of capital and maintain our operational resilience through a governance and control environment. And in the meantime, use that built up risk capacity as a core platform for our growth. From a customer centricity standpoint, as I mentioned, organizing ourselves and our operations around our customers, taking really deliberate steps to institutionalize the elements that will allow for us to listen intently to our customers and leverage the expertise and institutional capacity that we have to consistently exceed their expectations and ensure that any interactions with the group are indeed memorable ones. So again, I want to thank you, our shareholders, for your engagement as we talk to you about your business. And with that, I'll turn over to Kerry to lead our question and answer segment.
Thank you, Dane. Thank you, gentlemen. So now we're on to my favorite part of the investor briefing. You've heard from us, and now we want to hear from you. So we'll jump straight into our Q&A section. And just a reminder that if you do have any questions, please feel free to drop them into the Q&A section on the screen, and we'll pick them up as we go through. So I'll start with the ones that we've gotten so far. Our first question is about the BOJ policy rate. So on August 20th, the BOJ decreased the policy rate from 7% to 6.75%. What impact is this likely to have on the performance of the unit trust funds? Rahman, you're going to take that one?
Sure, I'll take that. So this is one of those questions that I wish that I had my crystal ball for, right? I usually get a few of those, but I can speak generally to what is expected from a market perspective and then tie that back to the unit trust funds, right? So the lowering of the policy rate by the BOJ is perfectly in line with their signal of moving towards an easier monetary policy position, right? And easier, relatively speaking, to what their posture would have been in previous months and quarters. Now, that is usually characterized by two things. Well, more than two things, but two things that I'll focus on. One is an improvement in market liquidity. So there's more money, generally speaking, out in the market to be invested. Right? And two is a reduction in interest rates, relatively speaking, across the curve. So shorter term rates, longer term rates. Right? And this is now underpinned by inflation that is within target levels and general stability. Now, if we're in such an environment, there are a few things that usually happen in financial markets. An environment like that is usually good for fixed income. So fixed income prices usually increase, at least fixed rate fixed income. It's usually good for equities as well, provided that companies are performing and the economy is growing on the back of this environment. And therefore, that coupled with more market liquidity, lower relative interest rates, those factors are usually good for the stock market. Right? So our unit trust funds span different asset classes. There is the capital growth fund, which is invested in local equities. There are the income and money market fund portfolios that are invested largely in fixed income, Jamaican dollar denominated fixed income with some allocations to US dollar denominated fixed income. There are US dollar funds, the FX bond fund, the FX accumulator fund, and the FX growth funds, which are invested in bonds, money market securities, and equities in US dollars, right? So the BOJ matter is locally focused, and we therefore expect an impact in the local market, which would be positive for our local funds. but it is also well aligned with generally what's happening globally, right? And if all those expectations carry through, it would seem as though risk assets, which have shown very diverse performances over the last couple of years in the face of higher rates. I mean, markets have been very volatile, right? Up, down, but in many cases, mostly down. It implies that there may be a positive future in the next couple of quarters for these risk assets. So it may mean that the unit trust funds could show better relative performance over the next several quarters, provided that the factors that I mentioned hold true, right? One important factor is growth. One important factor is companies performing. So let's see. But I certainly like the prospects for investing in this environment, on the back of expectations of lower rates.
Thank you, Rahman. All right. Our next question asks if we can give an update on the group restructuring exercise and what timeline are we looking at for completion?
I'll take that one. So the process for group reorganization continues. And, it's taking some time as we finalize the documents for that. And the process through the courts is being somewhat extended as we ensure that all or any stakeholder considerations are adequately taken into consideration. So it's taken a bit longer than we would have anticipated, but want to ensure that our stakeholders are satisfied as we go through the process.
Thanks, Dane. All right. So one of our guests is saying that they'd like to learn more about the real estate portfolio and how they can become a stakeholder.
I'll probably take that one as well. So that's a fund that actually missed me in my listing just now. But we do have a fund that invests primarily in real estate assets, and it's the Barita Real Estate Portfolio. And that unit trust fund, like others, simply requires someone to come in, be profiled from a risk perspective, from a goals perspective. Just generally, your circumstances would need to be assessed to determine whether an investment in this fund as part of your portfolio matches up from an overall assessment perspective, both with respect to risk and your ultimate objective. But outside of that, it's fairly easy. You open an account, we do the profiling, we have the discussion to the extent that it suits your portfolio. You can then subscribe for units in the fund. There are some limitations. I believe that there is a restriction with respect to how early you can cash out once you go in. Well, how early you can cash out without a penalty. But generally speaking, it's fairly straightforward to access it. So I encourage you to reach out to us via any of our mediums, whether it's through the website, whether it's through calling us, and just set up a discussion with one of our advisors to get going.
Thanks, Rahman. And of course, we look forward to hearing you and welcoming you on board as a Barita client. All right. So our next question is asking about the pipeline of equity offers that we may have over the next 6 months.
Sounds like me again. So I can speak very generally to this, right? What I'd say is that the circumstances that we have all collectively described, falling rates, higher market liquidity, are really good catalysts for an uplift in capital market activity generally. Now, what we have seen as an initial step is an uplift in fixed income offerings via the capital markets. Right? We have also seen an uptick in the number of IPOs and public offers that have come to the market, certainly this year relative to last year. Right? If you remember last year, 2023, we only had one IPO, which was brought to market by Barita. And this year, I believe we've had now two. So there has been 100% increase, right, in the number of IPOs, as well as we've had other public offers, an APO and so on. So with respect to our general outlook, we do have customers who are IPO ready. However, one critical consideration with respect to launching an IPO is market conditions, investor appetite, and so on. So we're still looking at these IPO-ready companies in that context to determine when's the best time to go to market. So there are opportunities out there, not only from our investment bank. When I speak to my counterparts, they have pipelines as well. So it really will come down to market conditions and the right time to launch.
Thanks, Ramon. So our next question is from one of our existing clients, who's saying that they would like to add money to their investment account via salary deduction, and is asking, how do they go about doing so? Dane, this one for you.
Yeah, I'll take that one. That's a fantastic question, and I say so because it's one of the ways that we really encourage our clients to approach their investments. And what that helps to do is, really make consistency, more convenient. And, like most things in life, consistency tends to be a great formula for success. So you're able to add to your investments through the salary reduction. There's a salary reduction form that's on our website. And that form can be returned to your Barita representative for them to update their records with us. And then the employers can then from there make the deductions via either check or bank transfer. The bank transfer is preferred. So what I would say though is that we note that question, and for sure we'll have your representative reach out to you to further that process. But again, definitely glad to see that investment posture, and it's an investment posture that we encourage throughout our overall client base. So happy to hear that.
Thank you, Dane. All right, our next question is asking, when will construction at Reggae Beach start?
That one appears to be from me as well. So good question. So it takes me back to the comments that I made regarding our real estate strategy, the fact that we have now gone squarely into the development phase. So one key part of the development phase is putting together a development schedule. Right? Now we have 8 properties in total in the portfolio that are slated for development. And there are a couple of considerations that drive the development schedule. Right? One is obviously market demand and market context. Second is the degree and extent of complexity associated with the project. The third would be the resources available to drive the development, and primary among those resources are ensuring that there is the right partnership in place to bring the development prospect to the appropriate level of tolerable risk. Right? At the end of the day, Barita sees itself with respect to its exposures to real estate as an investor. Right? We aren't a real estate company by any means. We see ourselves as an opportunistic investor. So it's important for us to get the right partners in the process to appropriately de-risk the associated investment, right? Or rather the development. So with respect to the timing of development for Reggae Beach, it is being determined by that development schedule. It is a fairly large and significant property, right? Well over 200 acres. And anyone can appreciate that the uses associated with it could be wide and varied, right? And our expectation is that the ultimate development of this property will be pivotal and impactful for the area in which it is located, right? So it therefore has to be done in the context of overall town planning. Right? Our understanding is that the location of Reggae Beach falls squarely into an area of focus for national development, right? For program national development. So for us, the timing will be driven by those factors. And so I can't tell you that it's going to be next quarter, unfortunately. But as the various factors that I mentioned become more certain, we will be communicating our expectation as to our time.
Thanks, Ramon. All right, so I think we have time for one or two last questions. We actually have a follow-up question in regards to the policy rates. We're being asked, do you expect FinCos to follow suit and lower their lending rates? And if so, how soon?
Yeah, that's always an interesting dynamic, right? And I think that dynamic was similarly interesting when rates were on the way up. So for context, I mean the policy rate would have moved all the way up to 7%. So the rise in rates in the policy rate would have been pretty significant, and though lending rates in the market would have risen, clearly it wouldn't have risen to that extent. So that being said, I expect generally that different institutions will consider the competitive environment as they look to adjust rates. I think this adjustment in rates is probably the first of what's expected to be a continuous adjustment over time. And I think you'll probably start to see elements of that play out as you see more rate reductions. And again, just taking into consideration that the pace of the rise in rates wouldn't have necessarily matched the increase in policy rates in steps. So I expect that a similar pace of increases that you'd have similar to the pace of increases on the way up, you probably see somewhat of a moderation in the pace of reductions in rates. So I think we'll need to see a couple more rate cuts before you start to see a material reduction in rates in the market.
Thank you, Dane. All right, I think that brings us to the end of our Q&A section. So thank you so much for your questions. And ladies and gentlemen, I would also like to really thank you for spending your afternoon with us as we close out for another session of our Barita Beat, the pulse of our performance, as we're able to share with you our Q3 2024 financial performance. Just a reminder that you can rewatch this session and any of our previous sessions on our website at www.barita.com/beat. And we, of course, really look forward to welcoming you again for the next one. So please make sure you're following us, keeping up to date, keep in tune for when we're announcing our Q4 session. Thank you all and have a wonderful afternoon. Thank you again to our executive team for sharing all of this information with us this afternoon. Take care and see you soon.